What if the most dangerous financial decision you could make during a recession is to do nothing at all? When the headlines scream market crash and every financial pundit predicts doom, our natural instinct is to pull back, to run for the safety of cash, to wait until the storm passes. But what if that very instinct, the one that feels so logical and safe, is actually a trap? What if it's the single biggest mistake that separates the average investor from the legendary fortunes of people like Warren Buffett? For the past 70 years, while others panicked, Buffett has used recessions to make some of the most profitable investments in history. He doesn't have a crystal ball. He can't predict when the market will hit rock bottom. What he has is a set of counterintuitive principles, a secret playbook that turns widespread fear into his single greatest advantage. Most investors think they know Buffett's advice. Be greedy when others are fearful. But that's just the tip of the iceberg. The real question is how. How do you know what to be greedy with? How do you act with confidence when your portfolio is bleeding red? In this video, we are going to pull back the curtain on Buffett's complete recession playbook. By the end of this analysis, you will not only understand his strategy, but you will have a clear, actionable framework to apply it. This is how you turn a period of fear into a foundation for generational wealth. All right, let's dive into the master's mind. It's crucial to understand that Buffett's strategy isn't about complex algorithms or risky bets. It's about psychology and discipline. The first and most important rule is to never try to time the market. The urge is almost irresistible. You see the market dropping, and you tell yourself, I'll just wait for it to hit the absolute lowest point, and then I'll buy in. The problem? You will never know when the bottom is until it's already in the rearview mirror. By the time the news is positive and the market feels safe again, the biggest gains have already been made. Think back to the 2008 financial crisis. In October of that year, Buffett announced he was buying American stocks. The market didn't bottom out until 5 months later. He didn't time it perfectly. His portfolio went down even further after he bought. But he wasn't trying to catch the bottom. He was buying when he knew he was getting a good deal. Those investments became phenomenally profitable because a great price is always better than a perfect time. The most powerful way to apply this is by adopting a strategy called dollar cost averaging. Decide on a fixed amount of money to invest at regular intervals. During a recession, your fixed investment buys more shares at a lower price, removing emotion and the impossible task of timing. Once you stop trying to find the perfect time, you can focus on the second rule. Focus on value, not on price. In a recession, the market is having a sale. Your job is to ignore the panic and focus on buying wonderful businesses at a fair, or even better, a discounted price. Buffett famously said, "Price is what you pay, value is what you get." A recession acts as a filter. It punishes weak companies and offers a rare opportunity to buy shares in truly excellent companies with strong competitive advantages, what Buffett calls a moat. While others were losing their shirts on dot-com startups with no earnings, Buffett was calmly holding businesses that survived and thrived once the dust settled. The actionable step here is to create a recession watch list. Identify 5 to 10 fantastic companies you've always wanted to own, but were too expensive. Research them now. When the market panics and their stock prices fall, you can act based on your research, not on fear. But buying great companies is only possible if your own financial house is in order. This brings us to the third and perhaps most urgent rule: pay off high-interest debt. Before you invest a single dollar, eliminate the single biggest threat to your financial future. Buffett considers high-interest credit card debt to be financial poison. Trying to out-invest a 20% interest rate is a losing game. Paying it off is the equivalent of getting a guaranteed, tax-free 20% return on your money. No investment in the world can safely offer that. The action is simple, but powerful. Implement the debt avalanche method. List all your debts from the highest interest rate to the lowest, and throw every extra dollar at the debt with the highest rate until it's gone. This solidifies your financial position before you build upon it. Embracing patience. Keep cash on the sidelines. Buffett calls this optionality. In a recession, cash is king because it gives you the power to act when others are forced to sell. Berkshire Hathaway is famous for holding massive amounts of cash, not out of fear, but out of patience. They are waiting for what Buffett calls a fat pitch, an unbelievably good investment opportunity that only appears during a crisis. He used this cash in 2008 to strike incredibly favorable deals with companies desperate for capital. You can play this game only if you have the cash ready. Your action step is to build a dedicated opportunity fund. This is separate from your emergency fund. Automate a small transfer from every paycheck into a high-yield savings account. Over time, you'll build a powerful war chest that gives you the confidence to seize opportunities. Once your debts are cleared, you can focus on building ammunition. Rule number 4 is about this leads to the final and most profound rule, the one that underpins all the others. Invest in yourself. Your own earning power is your single greatest asset, and a recession is the perfect time to sharpen it. Buffett has stated repeatedly that the best investment you can make is in yourself. Unlike stocks, nobody can tax your skills or take them away. During a downturn, the job market becomes more competitive. People who have invested in their own abilities are the ones who thrive. Learning a new skill, coding, digital marketing, a new language, can create new income streams or make you indispensable. The tangible action is to commit to a 1-hour learning rule. Dedicate 1 hour each day to developing a valuable skill. The return on this investment is often infinite. So, let's bring it all together. While the world sees a recession as a crisis, the Buffett mindset reframes it as a once-in-a-decade opportunity. The 5 rules form a powerful strategy. You throw out the impossible goal of timing the market and instead focus on the underlying value of great businesses. You strengthen your own fortress by attacking high-interest debt and building cash reserves. And most importantly, you make the ultimate investment in yourself. The average person will see the next recession and they will freeze. They will sell at the bottom and buy back at the top. But you won't. You now have the framework to see what they don't see. You have the rules to act with confidence when others are paralyzed by fear. The next downturn is not a threat. It is an invitation. Now I want to hear from you. Out of these 5 rules, which one resonated with you the most? Is it building that opportunity fund, creating a watch list, or finally tackling that high-interest debt? Let me know in the comments below. If you found this breakdown valuable, make sure to hit that subscribe button and turn on notifications. And if you want to continue your journey into timeless financial wisdom, I highly recommend you check out our next video, The Psychology of Money, 5 Unbreakable Truths. It's a perfect companion to what you've learned today.